Chapter 2 handout. And hopefully we'll get started on problem PR 2-2A. We'll see what time, if time permits, we'll get started on these two. Those are the next two that we'll have. I didn't send the answer sheet out yet in the email. I did. There actually are in the files on the in Blackboard, but I'll send those out if we get to those. I don't. I hate to send out files that we don't use and people pull them up and they don't. They're not used. So let's take a look here. All right. So I need to share. Okay. So I think we finished up here. Number 7. So I think we're on number 8. Okay. I think I'm going to put this over here. Okay, so number 8. Number 8 is similar to number 7. And let's see, it's May 13th. Okay, customer paid cash towards their account, $100. So what accounts are we going to use?
Is it going to be cash?
Yep. Cash will be one. So this is a caps on. So this is a customer. They paid us. So will the cash go up or down? So a customer paid us cash, $100.
Can I go up?
Yep. Increase. Yeah, let's make it a little more festive. We'll make it yeller. And what's going to be the other account? Now, the question is, what account did they pay on? What account is it when someone else owes us money?
Accounts receivable.
Yep. Accounts receivable. Okay, so the accounts receivable, so they owed us money, they just paid it. Is the accounts receivable going to go up or down?
No.
Yep, good. Yeah, they no longer owe us, right? They just paid us. It's similar to this one from a week ago, which I know is like a long time ago. All right, so cash is going to go up. And accounts receivable is going to go down. And by the way, I think I got this over here. I think you guys can do a side-by-side on your screen, hopefully. I can't really do it on mine. But hopefully you guys can do it. And anyway, if it doesn't work that way, I can always go down here and do it. I'll do it down here for now. But the so let's take a look at the account. So cash is going up. Cash is an asset going up. The debit. Accounts receivable. It's also an asset. It's going down with a credit. So one asset's going up, the other one's going down. Yeah, I think I'm going to do it on the one next to it. I think I'm going to use this one. I can't imagine me flipping through a Word document for 20 journal entries. Is going to be a very good study. Okay, so cash. It's an asset going up. And accounts receivable. It's an asset going down for 100. And again, the reason why we do these journal entries is they're so much faster to do. They're not now because we're getting used to them, but this is a whole lot faster to write than that. So we talk about journal entries. It sounds a little funny that they're still called that, but it really is just a quick way of writing down a transaction. Take the two counts you need, put them in debit or credit, and you're done. Okay. Paid off a few of the accounts payable, $400. All right, what accounts are we going to use?
Cash.
Yep. Cash, did it go up or down?
Increase.
Down.
Yeah, it actually went down. We paid off.
Cash went down.
Yeah, we're the ones paying on this one. This one was a customer paying us. This down here is us paying off you. So this is going to go down. All right, and the other account will be
Accounts payable.
Accounts payable.
yep. And is it going up or down?
Down.
Yes, good. Oops. What happened here? Oh, I did something wrong. There we go. Yeah, so they're both going down. Our cash is going down and our accounts payable is going down. So we no longer owe 400 of the accounts payable. Okay, so it's 5 times 20. Okay. Well, I think I'm going to go over to here. I'm going to see if I can get this set up so I can actually see it. Okay, so cash, it's an asset that's going down. It'll decrease with a credit. Liabilities, accounts payable is a liability, and it's going down. It'll decrease with a debit. Okay, so let me go back to sharing. Yeah, so I'm sorry. Let me focus that up. That might even be better. You can actually see it. There we go. Okay, so accounts payable. And again, I'm putting the debits first. You do not have to do this. At least in this case, you don't have to do it. So liability going down. Cash is an asset going down. So they're both going down. If you think about the balance sheet, cash is an asset, it's decreasing, and it won't balance if you just have one account. So then the other side is the liabilities are also going down by 400. So you have less assets, but you also have less liabilities. Okay, made a payment towards the mortgage. Fairly similar to the other one. What are the accounts we're going to use?
Cash.
and mortgage payable.
Yep and yep. Okay, and cash is going, it's just like this one. We're going to pay it off, part of the mortgage, so. Why do we keep doing that? I think I know what it is. I can't do the, yeah, the color thing takes it off. Okay. The same date, yep. Okay, so May. So if accounts payable, let's see, mortgage payable. So liability is going down. And cash is an asset. It's just like this other one up here. It's just like this one. Excuse me. Purchased office equipment on credit. $1,110 on June 9th. So what accounts are we going to use for that?
Cash and equipment.
Close. The equipment, yeah, we're going to do the equipment. We're not going to use cash yet. Eventually we will. You may put office equipment here too. Some of the. Well, what's going to be on the other side? So we bought it on credit. We didn't pay for it yet.
Is it accounts payable?
Yes. Yeah, so it can be a liability and it's going to be accounts payable. Okay, so now we have to see the office equipment. Is it going up or down? Do we have more office equipment or less office equipment?
Up.
Up, yep. Did it again. All right. And the accounts payable.
Up.
Yes. Good. We owe more. No, we owe another $1,110 now. So these are both going up. All right. So over here, office equipment, just gonna be like equipment. Can you guys see that, or is it too small? I don't know if you guys can do the side by side. Is it too small?
So small.
I'm pointing at the other camera I have. This, I think no one can see this one, so I'm going to change tactics now. And so let me go. So I'm just going to go down to the bottom here. Okay. So our equipment. It's an asset, and it's going up, so it'll be that. So increase equipment is going to increase with a debit. Our accounts payable liability, and it's going to increase with a credit. So equipment's the debit, accounts payable is the credit. And you guys are, I'm sure, catching on to the method here. Actually, if you have two accounts and you know what one of them is, you know what the other one is too, right? I mean, because the debits have to equal the credit. So, okay, so office equipment, you can just put equipment there. That's fine. No, I can't. I'm sorry. Not yet. So the office equipment's going up, and the liabilities, that's the tricky one, to me anyways. That's the tricky one because it is you think about it, this is we owe more money, so it's increasing. So accounts payable is when we owe more money. So this is going to be going, that's why the liabilities are going up. And I know a lot of times you think about liabilities and you go, oh, it's negative, but the actual amount you owe is going up here, or that the company owes. Okay. Purchase supplies using cash. What accounts?
Cash.
Yep. And
Supplies.
yep. Cash and supplies. Okay, so is cash going up or down?
Down.
Down. Supplies?
Up.
Yep. And so we come down here. Cash. I'll do the yellow. Cash is an asset going down. Supplies. Should have lighter color there. We'll do that, I guess. Supplies is an asset, and it's going up.
Up.
So supplies will be the debit, cash will be the credit. We're really just trading one asset for another. We're out $330 in cash, but we got supplies that are worth $330. So I really know. If you think about it, we're no better or worse off right now. Okay, issued common stock. What does issued mean?
That's sold.
Sold.
Yep. Very good. So we sold common stock for cash, $4,000. Okay, what accounts?
Cash and common stock.
Yep, and yep. Oops, I might put stock. Cash going up or down?
Up.
Common stock?
Down.
Closed. It's actually going to go. Do we have more owners or less?
Or more.
More.
Yeah. Up.
Go up, right? So these are both going up. So and if you think about this, cash is on the asset side, and this is on the liability equity side. So if the cash side goes up, and the other side needs to do something here. So 6-23. Okay, so cash is going to go up. In common stock, it is kind of a tricky one here because you think about, okay, well, these stock certificates are going out. They must be, but it actually has to go by ownership, and that the ownership is actually going up. Yeah, so if you think about it, we have more owners. I mean, you do think about the stock actually leaving the place, but what it really indicates is that there's more owners out there. Oh, I have to put a credit there. It's not going to balance unless I do something. Okay. Receive cash from customer previously billed. What accounts?
Cash and accounts receivable.
Yep, and yep. Cash going up or down?
Up.
Up.
And accounts receivable,
Up.
this is going to go
Yeah.
down, right? So this is accounts. This is what they owed us. The accounts receivable. So now that they paid it, they don't owe us. So the accounts receivable is going to go down, but the cash is going up.
Yeah.
Now we're still happy though because we'd rather have the cash than the accounts receivable. But okay, so cash is going down. No, it's not. Cash is going up. So cash is going up. Accounts receivable is going down. So cash is an asset, it's going up, but they no longer owe us. So the accounts receivable is going to go down. But we're still glad to get the cash rather than not having the cash. Okay, so cash. They no longer owe us for this accounts receivable. It's really just swapping one asset for another. Although it kind of goes without saying, we would all rather have the cash than somebody owing us money. Spilled water on myself. Okay. Paid all the accounts payable, 1,100.
Cash.
Yep. And
Accounts payable.
Accounts payable.
yeah, you're right. Accounts payable going down. So cash is going down. And accounts payable. Do we owe more or less now?
Less.
Now.
Yep. Okay, so it's June 29th. So cash is going down. So cash is going down. It's an asset going down. And accounts payable is a liability, and it is going down. So the accounts payable is going down. It's going to decrease with the debit. You can see this down here too. On this one down here. When you get more used to the assets and liabilities, and that you can just go down here. But the liabilities, they go down on the the debit side. So assets will go down in here, and these will go down in here. It's really an ingenious system. I mean, I think they came up with it 400 years ago, and we're still using it. How many things that from 400 years ago are we still using? Alphabet and numbers, and this. But anyway, so this is it is kind of ingenious. But so the assets will go down with a credit, liabilities will go down with a debit. And that's kind of why how they came up with these will always, if you have a debit and a credit, it's always going to work out. Okay, so accounts receivable is, excuse me, accounts payable is going down. So we don't owe, well, so we paid all of them. So we don't owe anything, I guess. And our cash is also going, it's an asset going down. So we have less cash asset, but we also have paid off our liabilities. Question on that? Okay, down here, this is going to get a little bit trickier. Up until this point, we've been pretty much jumping around the balance sheet. You know, assets, liabilities, equity, a little bit, you know, but we've been basically jumping around the balance sheet. This is when we actually kind of introduce the expenses and revenues. So we're going to have a couple more things here. If you look down on this this email here, so this is what we're talking about. These, you know, revenues and expensive costs. These are we're talking about. So now the nice thing about revenues and expenses, revenues are always credits. And expenses are always debits. Oops. Learn how to use a computer. So, and if you think about this, now if you only have two accounts, and if one of them is a revenue or an expense, you say yeehaw, because you know that if it's a revenue, it's a credit, and whatever the other account is, it goes on the other side, right? So if you have a revenue, you know, okay, revenue is a credit, whatever the other account is going to be the debit. And same thing here, if it's an expense, expenses are always debits. So if you have an expense, there will, whatever goes on the other side. And another thing is, let me think of this, if this is true, you'll never have these two together unless it's like an error or something like that. But revenues and expenses will never be together unless you're correcting an error or something weird happened. Okay, so let's go here. We received a utility bill for $200. Now, it doesn't say that we paid it. So let's assume that it wasn't paid. All right. So we received a utility bill for $200. What accounts are we going to use? First of all, is it money coming in, or is it going to be money coming in or money going out?
Going out.
Going out. So it's going to be an expense.
Utilities expense.
Yep. Yeah, probably be a utilities expense. Okay. So let's go back up here. We'll put that in. Okay. Now, utilities expense. Expenses are always increasing. You know, what's more, 1 month's worth of rent or 2 months worth of rent? So they're always increasing. But even better than that, you know exactly where it's going to go down here. Utility expense, they're always debits. You know, look down at the sheet here. Expenses, debits. That's it. If you come down here, same thing. expenses, debits. Okay, what's going to go on the other side though? We received a utility bill. We haven't paid it yet. So we
Accounts payable.
Yep. Perfect. And accounts payable going up or down?
Up.
Yep. We owe more money now. Okay, so utilities expense. $200 debit, and I'm going to put down here in parentheses. Yeah, expenses are always debits unless there's something weird going on, you know, some error correction or some weird bookkeeping thing. Yeah, I'll put it this way: 99.99% of the time they're they're debits. So, you know, if you do 10,000 of these, you might be wrong once. All right, and the accounts payable is a liability going up. Liability. The liability increases with the credit. But again, you know, you already knew that because debits are always, expenses are always debits. So you know that whatever goes on the other side. Okay. We owe employees for 1 week of wages. So what accounts are we going to use?
Wages expense.
Yep. And expenses are always increasing. And let's go on the other side.
Cash?
Probably not yet. Eventually, yeah, we're going to have to pay them, but this says that we owe them for
Payable.
yeah.
Accounts payable.
Maybe accounts payable. The book could probably use wages payable, but I would certainly accept accounts payable too. Some kind of liability. Now, the liability, is it going up or down? Do we owe more or less?
Up.
Yep. We owe, whatever this is, $1,600 more now. And again, debits and credits, expense, always debits. You know, if you look down at the accounts down there, expenses are debits. So whenever you do run into an expense, you say hooray. Well, you probably don't say hooray. But if you're the accountant, you say hooray because now you know what that it's going to be a debit. You don't have to worry about is it a debit or credit. If it's an expense, it's a debit. And wages payable is the liability. Accounts payable is fine too. You put accounts payable, that's fine. And it's also going up by 1,600. So, going down here to this thing. Accounts payable up, it's increasing with a credit, we owe more. By the way, if you look at this thing down here at the very end, this thing, I'm gonna zoom out a little bit here. Too much. Okay. If you're wondering, like, why are these grouped like this? Why do expenses and assets go up with debits? Why do revenues, liabilities, and equity go up with credits? Why is that? Why does it do that? Expenses and assets are things that you spend money on, right? This is what you use money for. You pay the phone bill, the expense, or you buy equipment. So this is actually money going out of the place. This is how you pay your bills or get assets, buy equipment, buy supplies or whatever. So this is what you spend money on. On the right-hand side is how you get money. So this is money coming in. So how do you get money? You could sell something. Revenues would be selling something to get money in. Liabilities are you borrow money. And down here is you could hit the owners up for money. So how do you get money? You sell something, or you borrow the money, or you get it from the owners. So this side is money coming in, so the right side is money coming in, the left side is money going out. So that's why they're kind of categorized like that. And pretty much any wacky transaction you can think of fits into this, these 5 general kind of categories. It's in a weird way, it's kind of a beautiful system. Oh, wait a minute, what did I do here? Oh, I made this way too small. Sorry. What did you guys learn in class today? Mr. Taylor doesn't know how to use a computer. That's what we learned. All right. Sold common stock to an investor, $3,800. What accounts?
common stock,
Yep. And what other account?
Cash.
Yep. Okay, common stock, increasing or decreasing? Do we have more owners or less?
increase,
Yep. Cash.
increase,
Huh?
Okay. So cash is going to go up. Cash is an asset. It's going to go up with a debit. Common stock is equity. And it's going to increase with a credit. And so this is, talk about getting money into the place. Well, this is what they just did. How they get money in, they hit the owners up. They could have got a loan, they could have sold something, but in this case, they said, hey, we need more money, and we got more investors, or either more investors or more of a bigger investment from the current investors. Paid dividends to shareholders. This one's a little bit of a weird account. What account do we use? I can't remember if we covered this one before. Maybe we didn't. Dividends are a weird account. If you go all the way down here to the bottom, this thing. Dividends will be a debit. Most textbooks will say dividends will be going up, and they'll be going up, and then they'll be subtracted from the retained earnings. So the dividends themselves will be going up with a debit. Now, if they run it straight through retained earnings will be going down with a debit. So it's kind of a weird account. It's kind of a strange thing. Some companies use dividends, a dividend account. Some companies don't. They just go right through retained earnings. The book shows it using a dividends account. So whenever you see dividends, it's always a debit, kind of like expenses. It's not an expense, but it's always a debit. Okay, so, and dividends are payments made to the owners. So dividends, and what do we pay them with?
Cash.
Cash. Cash going up or down?
Down.
Okay, so dividends. That's not how you spell dividends. Let's try that again. Dividends are always going to be debits. Cash. Okay. 20, perform services for cash, 280. So we did some work for somebody. And
Service revenue.
Yeah. So service revenue. Yeah, some kind of revenue. And revenues are always increasing. Okay, what's going to be on the other side?
Cash.
Yep. Going up or down?
Up.
Up. Oh, I did it again. Okay. All right, so I'm going to go down to the bottom here. So revenues are none of those you say yippee when you see it because you know they're credits. And whatever's on the other side is going to be the debit. So whenever you see a revenue, it can only be one thing. It's going to be a credit. Whatever the other account is going to be the debit. So getting the debits and credits right is going to be a problem. Now down here, if you look at cash, ooh, look at that. Okay, so cash, it's an asset. It's going to increase with a debit. Like I say, you already knew that because the revenues, it's a credit, whatever's on the other side is going to be the debit. Okay, so cash. Yeah, you know, it's something that counts. Like, you know, we use cash so much. You guys are probably getting used to it. That cash goes up with a debit, cash goes down with a credit. And service revenue. They're always increasing, always credits. Oops. Dang. I'll have to alter my spacing here. Uh, 21, billed customer for services delivered, $550. Okay, now, so we handed them a bill. We did the services. And by the way, whenever you see billed, that sort of indicates that we did our part. You don't just hand someone a bill if you didn't do anything. So usually if you hand a bill to somebody, it's because you've completed the service. So you bill the customer for the services for $550. Now, it doesn't say anything on here about receiving cash. So what accounts are we going to use?
Accounts receivable.
Yes. And what's going to be on the other side?
Service revenue.
Perfect. Yep. And service revenue is going to be increasing. They always increase. The accounts receivable, is it going up or down?
Up.
Yep. Okay. Well, going down here. Revenues, always credits. Accounts receivable, it's going up. Accounts receivable is an asset. It's going up with a debit. I don't know. I don't know if these colors are more confusing or what, but so anyway, accounts receivable, it's an asset. And it's going up, so it'll go up with a debit. Again, you already knew that because the revenues are always credits. And I don't care which ones you put first. If you put the credits first, as long as it's the right, the right thing is being credited, that's fine. As long as you put the revenue. Okay. And I'm going to just copy this down here. So revenues are always credit. So if you do it into a revenue, you really don't even have to go look up that accounts receivable because you'll know what it is. The revenues are going to be credit, whatever the other account is, whether it's accounts receivable or cash or whatever, it's going to be the debit. Okay, how about 22? What accounts?
Service revenue and account receivable.
Yeah, it actually is exactly the same as 21, right?
Yeah.
I mean, probably different customer, different date and all that, but the accounts that aren't spelled like that. And those are both increasing. And it's exactly the same as up there. And another thing about accounting is that you get used to making the transactions that happen frequently. You get very used to making those journal entries to the point where it's almost difficult to make a mistake. You know them so well. Oops. And by the way, you don't have to put these in this asset thing in there. I think on the test I'll give you these up here, but if you want, if you feel comfortable enough, you can just put them into the journal entries. That's fine too. I've done this though, even though if you get into more complex journal entries, sometimes I'll kind of chart out what goes up and what goes down. Oops. Okay, wages owed to employees at the end of month 390. We had something similar to that. Did we pay them yet? Nope.
No. So accounts payable.
Good. And what's the other account probably going to be?
Wages expense.
Good. And so accounts, I'm going to put in wages payable, but accounts payable is absolutely fine. And well, let's take the expense first because that one is the easiest of the two. If it's an expense, it's a debit. So wages expense, it's a debit. Now the wages payable, is going to be the credit. And you can also go look at that down here. Don't say any other payables. So any other payables, so it'll be wages payable, liability, increase with credit. But again, you know, the nice thing about expenses and revenues, but expenses, you know exactly what debit. Okay, paid the current month's rent, $2,200. What will be the journal entry for that? What will be the accounts we'll use? What does paid indicate? What account?
Cash.
Yep. So paid is the magic word for cash. Okay, it's probably not a magic word. What's gonna be on the other side?
Rent expense.
Rent expense.
Yep.
Yeah.
Like rent expense. Yeah, so rent expense, nice thing about expenses is they're always debits. So rent expense would be the debit. Cash is going
Down.
down, so it'll be credit, which again you already knew. Oh, I didn't finish this up here. What am I doing? Okay, so this is rent expense. So cash is gonna go down. We paid it. Rent expense is always going up. And rent expense is always the debit. Okay. Oh, wait. Okay, so rent expense always the cash. Asset going down, we're paying the rent. Okay, purchase supplies on account.
Supplies and cash.
Close. The supplies,
Accounts payable.
That's
Probably
payable,
getting
yeah.
Accounts payable.
they probably didn't, it doesn't look like they paid it, so at least not yet. So accounts payable, so they owe them for it. Yeah, you know, the accounts payable you guys probably picked up on. It's really just a timing difference. I mean, it's not, you are gonna end up paying for that in cash, but you know, it's a timing thing. Okay, so supplies, is it going up or down?
Up.
And the tricky one, accounts payable, is it going up or down?
Up.
Up, good, we owe more. So we got more supplies, but we owe more money, so. Okay, so. Supplies. Asset going up. The color that makes it impossible to read. So, surprised I'm using it. So supplies, and you're gonna increase with debits. Accounts payable. Going to increase with a credit. So we have 160 more of supplies, but now we owe 160 more. Accounts payable. Oops, that's not an asset, it's a liability.
Hey, Mark,
Yeah,
can you go back up to number 23? Yeah, what was the increase and decrease for those?
oh gee. Hard to tell, isn't it, since I don't have it in there. They'd both be increasing.
Okay, thank you.
Yeah. Apologies, I didn't mean to leave it. Yeah, the wages are, the payable's increasing because we owe more now. We owe $390. And expenses are always increasing. And the idea is that as time goes on, they just keep going up and up and up throughout the year. That it keeps getting added on. What's more, 1 month's worth of wage expense or 2 months? Well, 2 months. So as time goes on, they just keep going up and up and up. All right, 26. Paid for the supplies purchased on account in number 25.
Cash and accounts payable.
Yep. Cash going up or down, that's not highest bill. Cash going up or down?
Down.
And accounts payable?
Down.
Down. Yep. Good, good, good. So cash going to decrease with the credit. Accounts payable is going to decrease with the debit. So you kind of see that, it really is just a timing difference here. The accounts payable is kind of like it's anything accounts receivable. It's timing difference between when the transaction happens and when the actual payment is made. Okay, so accounts payable. Liability is going, it's going down. We're not paying 60. And our cash. And again, and the test and all that stuff, you don't need to put it as asset minus. I do that just so you know how I came up with the debits and credits on. Here's one we did not talk about. This is a wacky one. Received an advance payment from a customer, $220. Okay, so they paid in advance. So they paid us with
Unearned revenue.
Oh yes, yes. You get them the hard drive. So they gave us cash, but we're also going to have unearned revenue, which really isn't a revenue at all. Unearned revenue is a liability. So we got cash, so that'll increase. Now, here's the thing. They paid us ahead of time. Okay, okay, so they paid us ahead of time. So this is a liability that if we don't do our, whatever it is that they paid ahead of time, if we don't do the work that they paid us for, we got to give them the money back. So this is a liability, and it's a liability going up. They paid us $220, but if we don't do what we're supposed to do, we got to give back the $220. Okay, so I'll put this in there so we'll okay. Oops. Cash is an asset. Going up. And unearned revenue is a liability. And it's going up with a credit. Oh, yes, that is right. I just confused myself. In the basement, my nose, it's freezing down here. My nose is running. Okay. So any questions on any of that? Okay, let me. Okay, I think I'm gonna call it a night there. There's only so much of these you can do, and then you're just wasting time trying to. But I'm gonna give you guys a kind of a heads up. So for next class, here's what we're gonna go over next class. And if you want to, you can go ahead and see if you want to work to, give these a shot on your own, and we go through it. You may kind of follow along. So with these two problems, are what we're going to be covering next class. We're going to do this one in class, and then this one I'll probably give you to do on your own. I'm not sure of the page number on this. I think this one might be on page 97-ish, somewhere in there. I think this one's on page 100. If you're using the the hardcover or the loose leaf one. But these are in chapter 2, and I'll go ahead and send you guys the. Well, after class, I'll send you guys the sheet we're going to have. It's also in Blackboard. It's under the files, but it's similar to what we were just working on. It's similar to. Not that. It's similar to this, but for the accounts in the problems. So for next time, we'll go there. So problem 2-2A, and I'll have the information for this one up on the little screen on the side. But the problem 2-2A and then problem 2-2B, I'll let you guys do on your own next week. And we might do the practice exam next week. So so next week, yeah, we'll go over this. Right. Any questions? But I'll go ahead and email you guys those answers, the answer sheet, which is similar to what we just did. And again, if you want to, you can work ahead. If you don't want to, that's fine too. But just so you can kind of see where we're going. And the test over chapter 2 is basically going to be all journal entries. That's basically what we've learned in chapter 2. There might be I shouldn't say that. I might have a handful of multiple choice questions, but for the most part, it's going to be just doing journal entries. I mean, that's the main part of it. And in the chapter, they have a whole bunch of other stuff in there. Don't worry about it. There's stuff that we'll cover later on. But any questions on this?
No.
Okay. Yeah. Well, I mean, hopefully it it's starting to click. But again, this is weird stuff. It's a 400-year-old shorthand is what we're learning. It works, but it's quirky. This is not as easy as you may think. But again, it does what we need it to do. So, okay. Well, I will send you guys out the answer sheets for those two problems. And if you have any questions on it, if you're curious about one of them, you can't figure one of them out or something like that, you can go ahead and email me, and I'll be happy to take a look at it. If you haven't turned into chapter 1 stuff, you can turn it in still without penalty. Now, it's obviously not going to be in your grade to date until you do. So your grade to date's going to look bad until you do. But you can certainly turn in, the stuff. I don't mark things down, after. And the grades to date are up, so you can kind of see where you're at. If you have any questions on your grade, you can feel free to email me. Any questions on that? Okay, so today I'm going to put in under submit coursework here, I will put in the chapter 2 part 1, which we did last week, and the chapter 2 part 2 handout we finished this week. So I'll put those in. You can turn those in, and then if you want to start working on the problem 2-2A, feel free. Questions?